What are the main differences between a stock fund and a real estate fund? There actually are quite a lot of differences in the structure, in the way that distributions, other things are paid out. So let me go over a couple of the big issues. Some of them are a little technical that require either a broker-dealer to explain or an attorney to explain. So I'll just kind of mention some of these issues, but won't necessarily go into a lot of detail. First of all, stocks, bonds, and mutual funds are kind of the core assets that Wall Street sells. That's the basic stuff. Real estate, commodities, bottles of wine, collectibles, those are all considered alternatives. And they're alternatives because typically they're not commissioned by Wall Street. Wall Street doesn't necessarily get a commission on those, and they're not regulated the same way by the SEC. Now, their sale, of course, is potentially regulated, but not exactly in the same way. So here are a couple of the big issues. Number one, the big hedge funds, the big private equity outfits, the mutual funds, those companies, what they mostly are doing is taking baskets of assets, stocks, bonds, mutual funds, etc., and they're putting them under an umbrella, and they're trying to find deals where they can, make a little more money than the market, take a little more risk than maybe the market. And the way that they charge is called either 110 or 220. Maybe you've heard this before. So what 110 means is we're going to take a 1% management fee and 10% of the back end profit. So here's what that turns out to be. If you have a $1 billion fund, on January 1st, 1% is $10 million. They're going to scoop $10 million off the top, and then they're going to go do the rest of their business for the rest of the year. As you can imagine, the pension funds, the investors in these hedge funds and other kinds of outfits don't especially like this kind of deal because regardless of what the accomplishment is of the fund, taking a point off the top is pretty horrific. 220 is exactly the same thing. That's 2 points off the top and 20% of the back end. So if it's a more risky fund, if there's a higher yield fund, they'll do a 220 arrangement, or if it's a less so, they'll do a 110. Now, imagine what the hit is of a 110 or a 220 fund when the return on investment, let's say, is 6%. And a lot of times these funds are only returning, say, 6 or 6.5%. So when you take a full point or 2 points off the top, the yield to the investor now is somewhere in the neighborhood of 4%. And that really isn't a lot better than they're going to get anywhere else, which is the reason that they get so upset, is that they're taking a lot of risk for relatively the same amount of return. It really doesn't work that great. So, and the majority of these deals, whether they pay out a back end or not, when you're taking down those kind of management fees, the back end becomes secondary. So, very significant thing for us to pay attention to. They also don't take the kind of fees that we take in real estate. So in real estate, we might take a 10% back end, give the investors 90, it could be 20, 30, 40, even 50% to the promoter of the deal. So they're doing a 50-50 split. There might be a preferred return. The concept of preferred return doesn't really exist in a lot of those stock market deals. So because we have a lot of timing kind of related issues in real estate where you don't have liquidity, it might take a long time to see any profits. So there's a lot of issues related to making sure that investors get their cash. Another really important thing here is that in a fund like what we're talking about for real estate, unlike a stock company, the real estate investors are not buying a percentage of the company. They're really buying a percentage of the profits because they don't have any intention of holding those assets for forever. They don't have any intention of a public event. They really are holding them until the asset gets sold, and then they get a percentage of the profit, and then everybody gets their cash back they originally put in. Unlike in a stock market company where there's a different intention. There might be a long-term goal of sale. There might be a long-term goal of going public. So that's another very significant difference. So bottom line is the way these funds are regulated is different. The way the fee structure are paid is different. The way that we do it in real estate is very favorable to us because it allows us to take some of the back end, some of the cash flow distributions, and then we also get paid for the services that we render along the way. And I really never encourage those management fees because I find them to be very investor unfriendly, and you really don't want to be taking fees if you don't deserve them. I mean, if you haven't earned them, in other words, they're just pure overhead that wouldn't be there if it weren't for you. So I'm not in favor of that sort of thing. I mean, they're perfectly legal. You can do what you want as long as you make your proper disclosures, but I'm not in favor of doing those sort of things. So this is a great business. Just do it in a good way and you'll be successful with this. So go out and stake your claim.